And I feel like every day that I come on this program, we're looking at moves in the yield space of 10, 20 basis points or more.
Yeah, absolutely. And it's a great call out, Romaine. Look, we've seen in the last month or so a bit of a flight to safety trade, and that's happened in equity markets as we've seen more investors flock towards not only your traditional defensives like the consumer staples and healthcare part of the market, but also kind of your growth, quality growth parts of technology and comm services as well. But as you noted in the bond space, this has really played out with investors flocking towards treasuries, 10-year and 2-year, pushing yields downward. But of course, part of that move also comes as investor expectation and market expectations of Fed rate hikes moving forward have tempered as well. So we're looking at now maybe not even one additional rate hike ahead for the Fed. And of course, markets are starting to price in rate cuts as early as the July meeting. And so that has really weighed on Treasury yields as well. So we're, really went from a 5% plus environment just a couple of weeks ago to a sub 4% environment, as you noted.
And then, of course, the differential between the short end and the longer end means that we have an inversion, particularly, let's just take the 210 to cherry pick here, which was negative 1%. I don't know, it was at the start of this month, I believe. And now we're something around 40, 41 with the minus sign in front of it. That would suggest a steepening. That would suggest what?
Yeah, interestingly, historically, when the yield curve starts to steepen like this off a very negative base, over the past 30 years, what that has indicated is that the Fed is about to pause its rate hiking cycle. And of course, that aligns to what we heard from Jerome Powell and team yesterday to some extent. They did show in their new set of economic projections that 5.1% holds as their peak terminal rate. For now, at least, that would imply maybe one more rate hike. And they also, of course, softened their language yesterday, saying instead of ongoing, perhaps some additional tightening may be necessary. And so I do think all stars are aligning towards perhaps a Fed that is towards the end of its rate hiking cycle. The steepening of the yield curve certainly kind of alludes to that as well.
And when we talk about the path forward for the Fed, at least when it comes to rate hikes, it feels like we talk about it as if they're going to hike and then they're going to pause, and then the next move after the pause is a cut. But given the uncertainty there is right now, particularly around what's happening in the banking system, how possible is it that we see a sort of stop and pause and go again sort of rate hiking cycle?
Yeah, I think that's a great question and a great point, because it does talk to the uncertainty of how the different scenarios play out. And it was interesting to hear even Jerome Powell yesterday say that while there is heightened uncertainty in the regional banking system now, it's very recent and it could fade over time, and it could fade perhaps rapidly. If that does happen and we're back to talking about a very tight labor market, wage growth that continues to remain elevated, the Fed's job is not yet done. But what I will say is that what also came out of yesterday's meeting was that Jerome Powell noted that some of the recent tightening we've seen, credit conditions tightening, that also does act in some ways as an implicit rate hike as well. So it was interesting to hear him equate the credit tightening with rate hikes as well. So I do think that some of the Fed's job is done for it as we're kind of seeing this banking crisis play out. Now, if this continues for an extended period of time, perhaps the silver lining on the whole regional banking crisis will be that some of the more stickier parts of inflation, including, that services wage inflation, will moderate over time as well. So depending on which direction the banking crisis plays out, I think you'll get your answer as to whether or not we're at a pause and a cut or a pause and a reaccelerate.
Well, you brought up what I thought was the most interesting part of Jerome Powell's speech yesterday, which is basically the tightening that you're seeing as a result of what's going on in the banking sector, that you can think about it as the same sort of effect that a rate hike would have. But given that it's not interest rates going higher, it's a different sort of tightening that's going on, does that change at all how you invest?
It's interesting. I do think that over time, what we're looking for is inflation to moderate, the economy to decelerate into what we would call a mild economic downturn, mild recession, and then markets to actually go through a bottoming process, but then look forward towards a more recovery type of playbook. So for now, we would say investors are acting rationally in that they are, a little bit more defensively postured near term. But over time, we would say, that that recovery playbook, which will include more cyclical parts of the market that are being shunned right now, maybe more small caps, more international, more longer duration assets in equities and bonds, that will have a place in your playbook probably in the months ahead when we go through this kind of bottoming process. But for now, we'd say, given what's happening in the banking sector, the uncertainty there, how that will play out, what mechanisms it'll go through. It does seem like over time that could slow the hiring process, especially if new businesses and existing businesses have trouble getting loans, put aside projects, put aside hiring. All of that kind of plays through, hopefully, eventually through the labor mechanism and the wage mechanism as well.